January 23rd, 2026, a date that will echo through financial history books for decades to come. While most Americans slept, tucked safely in their beds dreaming of weekend plans and Monday morning meetings, something unprecedented was unfolding in the digital vaults and trading floors scattered across the globe. Silver shattered through $100 per ounce for the first time in human history. Gold pierced $4,500, racing toward a target that seemed impossible just 18 months ago. And in the hushed corridors of Germany's Bundesbank, politicians and economists were drafting urgent letters demanding the immediate repatriation of 1.2 million kilograms of gold currently sitting in Federal Reserve vaults beneath the streets of Manhattan. Not since the collapse of the Bretton Woods system in 1971 has the global monetary order faced such a dramatic reckoning. But this story doesn't begin in 2026. It doesn't even begin in 2025, when gold first breached $3,000 and financial analysts started using words like unprecedented and paradigm shift in their morning briefings. No, this story begins 75 years ago, in the smoking ruins of post-war Europe, when Germany made a decision that seemed logical, even prudent at the time, a decision that would haunt them 3/4 of a century later. After World War II, as the German economy experienced what economists would later call the Wirtschaftswunder, the economic miracle, the country began accumulating massive trade surpluses. Under the Bretton Woods system, these surpluses were converted into gold, mountains of it. Thousands upon thousands of gleaming bars, each one stamped with the eagle of the Bundesbank, each one representing the sweat and ingenuity of a nation rebuilding itself from ashes. But where do you store such wealth when Soviet tanks are positioned just beyond your eastern border? When the threat of invasion looms like a dark cloud over every strategic decision? The answer seemed obvious. You send it west. You send it to your strongest ally, to the nation that helped rebuild you through the Marshall Plan, to the country whose military umbrella shields you from communist expansion. You send it to America. And so, plane after plane, ship after ship, Germany's gold made the journey across the Atlantic, disappearing into the underground vaults of the New York Federal Reserve, that imposing fortress on Liberty Street where the bedrock of Manhattan Island was carved out to create one of the most secure storage facilities ever constructed. 80 feet below sea level, behind a 90-ton steel cylinder that serves as a vault door, Germany's gold joined reserves from dozens of other nations, all seeking the same thing: safety, security, the protection of the world's hegemon. For decades, this arrangement worked flawlessly. German politicians slept soundly, knowing their gold was guarded by the full might of American power. The Bundesbank officials, who occasionally made the pilgrimage to New York to inspect the reserves, returned with glowing reports. Everything was in order. The bars were there, precisely cataloged, exactly where they should be. Trust was implicit, absolute, unquestioning. But trust, like gold itself, can be a surprisingly fragile thing. The first hairline fracture appeared not in New York, but in Moscow. February 24th, 2022. Russian tanks rolled across the Ukrainian border in a massive invasion that shocked the world. The Western response was swift and unprecedented. Within days, the United States and European Union announced a sanctions package unlike anything seen before. Russian banks were cut off from the SWIFT payment system. Russian oligarchs saw their yachts seized in Mediterranean ports, their London townhouses frozen, their Swiss bank accounts locked. But the move that sent tremors through central banks worldwide was this: the freezing of the central bank of Russia's foreign reserves. Overnight, roughly $300 billion in Russian assets held in Western institutions became inaccessible. Think about that for a moment. A sovereign nation's central bank, the very institution charged with safeguarding that country's monetary stability, was suddenly unable to access its own reserves. Not because of bankruptcy, not because of default, but because of political decisions made in Washington, Brussels, and London. Whether you believe the sanctions were justified or not, whether you think Putin's regime deserved such treatment or not, is entirely beside the point. The precedent was set, the message was sent, the message was received. In capital cities from Beijing to Brasilia, from New Delhi to Dubai, central bank governors and finance ministers looked at their own reserve holdings and asked themselves a question that would have seemed paranoid just months earlier. Could this happen to us? The answer, uncomfortably, was yes. Yes, it could. If geopolitical winds shifted, if alliances fractured, if some future American administration decided your country was on the wrong side of history, your reserves could be frozen, seized, weaponized against you. The psychological impact of this realization cannot be overstated. For 70 years, the dollar system worked because of trust. Countries held dollars and dollar-denominated assets because they believed in the sanctity of property rights, because they trusted that America, whatever its flaws, would play by the rules. That trust didn't evaporate overnight, but it began to crack. and through those cracks, gold began to flow. Chinese central bank purchases accelerated. India increased its buying. Turkey, Poland, Singapore, Qatar, the list grew longer each quarter. By 2025, central banks were purchasing over 1,000 tons of gold annually, a level not seen since the 1960s. This wasn't panic buying. This was strategic repositioning, a slow-motion vote of no confidence in the existing monetary order. But the real shockwave came from an unexpected source. Not Beijing, not Moscow, but Berlin. Germany, the economic powerhouse of Europe, the nation whose currency was so trusted that when the European Union needed a model for the euro, they essentially copied the Bundesbank's inflation-fighting playbook, suddenly found itself asking uncomfortable questions about the gold it had stored in America for over half a century. The catalyst came from an unexpected alliance of economists, politicians, and ordinary citizens who began asking a simple question: if our gold is truly ours, why can't we see it whenever we want? The Bundesbank's initial response was dismissive, almost patronizing. The gold is safe, they assured the public. It's stored in the most secure facility in the world. There's no reason for concern. But the questions persisted, growing louder with each passing month. In 2013, under mounting pressure, the Bundesbank announced a plan to repatriate some of its gold reserves, a modest 300 tons over 7 years. Even this limited operation proved more difficult than expected. The logistics were complicated, they explained. The verification process was time-consuming. Moving gold isn't like transferring money electronically. These were physical bars, each weighing roughly 12.4 kilograms, each one requiring inspection, documentation, secure transport. By 2020, Germany had successfully brought home about half of what it intended, but roughly 1,236 tons remained in New York. And then everything changed. The Trump administration's return to power in 2025 brought with it a foreign policy approach that European leaders found increasingly difficult to predict. Tariffs appeared and disappeared based on presidential whims. NATO commitments were questioned publicly. Long-standing alliances were treated as transactional arrangements rather than sacred bonds. Traditional diplomatic niceties were abandoned in favor of what the administration called America First pragmatism. European capitals, already nervous about American reliability after the chaotic withdrawal from Afghanistan and the on-again, off-again commitment to Ukraine, became deeply unsettled. But it was a single comment made almost offhandedly during a press conference in late 2025 that sent German officials into emergency meetings. Asked about European defense spending and Germany's continued failure to meet NATO's 2% GDP target, the president responded with characteristic bluntness. They've been freeloading for decades, he said, living under our protection, storing their gold in our vaults, and they won't even pay their fair share. Maybe we should charge them storage fees. Maybe we should remind them what American protection is actually worth. The comment was probably meant as rhetorical pressure, a negotiating tactic to push Germany toward increased military spending. But in the febrile atmosphere of 2025, with gold prices already surging and central banks worldwide diversifying away from dollar assets, the words landed like a hand grenade. Storage fees on sovereign gold reserves? The implication was staggering. It suggested that Germany's gold wasn't truly Germany's, that access to it could be conditioned on political compliance, that the bars sitting in those New York vaults were, in essence, hostages. Within 48 hours, a group of prominent German economists published an open letter in the Frankfurter Allgemeine Zeitung, one of the country's most respected newspapers. The letter was direct, urgent, and unprecedented in its implications. The Federal Republic of Germany must immediately demand the complete and unconditional return of all gold reserves currently held in the United States. It read, "The recent statements from Washington make clear that our gold reserves can no longer be considered truly sovereign assets. Any delay in repatriation represents an unacceptable risk to German monetary independence." The letter was signed by former Bundesbank officials, university professors, think tank directors, a cross-section of Germany's economic establishment. This wasn't fringe thinking or conspiracy theory. This was mainstream concern, aired publicly, demanding immediate action. The political pressure became unbearable. Coalition government meetings ran late into the night. The Bundesbank, traditionally independent and resistant to political pressure, found itself caught between its desire to maintain good relations with the Federal Reserve and its constitutional obligation to safeguard German monetary sovereignty. Behind closed doors, German officials were making frantic phone calls to their American counterparts. What they heard did little to reassure them. Yes, the gold was there. Yes, Germany could have it back, but the process would take time. Perhaps 18 months, perhaps longer. After all, the bars would need to be verified, assayed, properly documented. Security arrangements would need to be coordinated. Transportation would need to be scheduled. It wasn't that America was refusing to return the gold, understand. It was just that these things took time. Lots of time. To German ears, already primed for suspicion, these reassurances sounded like stalling tactics. Why should it take 18 months to return gold that supposedly was sitting in clearly marked storage compartments, already cataloged, already documented? Unless, of course, it wasn't sitting there at all. Unless it had been leased out, hypothecated, used as collateral for financial operations that the Federal Reserve would rather not discuss publicly. The conspiracy theories that had bubbled in internet forums for years suddenly didn't seem quite so crazy. What if the gold wasn't there? What if decades of central bank gold leasing had created a situation where the same physical gold had been promised to multiple parties? What if the emperor had no clothes? Or in this case, what if the vault had no gold? Nobody in official positions was willing to say such things publicly, of course. The diplomatic and financial ramifications would be catastrophic. But privately, in secure conference rooms and encrypted phone calls, the possibility was being discussed at the highest levels. And here's where our story takes a turn that even the most creative thriller writer would hesitate to include for fear of straining credibility. Because while Germany was quietly panicking about its gold in New York, something extraordinary was happening in the gold market itself. The price wasn't just rising, it was exploding. January of 2026 opened with gold at approximately $3,700 per ounce. Within 3 weeks, it had surged past $4,500. Silver, which had been trading in the high 20s just months earlier, rocketed through $100 on January 23rd. These weren't normal market movements. These were the kind of price dislocations you see during currency crises, during moments when the entire financial system is being repriced. Goldman Sachs, perhaps the most influential investment bank on the planet, released a research note that sent tremors through trading floors worldwide. Their new price target for gold by the end of 2026, $5,400 per ounce. But it was the reasoning behind the forecast that truly caught attention. Goldman's analysts weren't citing traditional factors like jewelry demand in India or industrial usage in electronics. They weren't talking about inflation hedging or the usual narratives that drive gold commentary. Instead, they pointed to something far more fundamental, far more revolutionary: central bank demand, sovereign wealth fund accumulation, and most ominously, what they called private sector flight to safety amid monetary system uncertainty. Let that phrase sink in for a moment. Monetary system uncertainty. This wasn't coming from some fringe newsletter or doom and gloom podcast. This was Goldman Sachs, the bank that advises governments and central banks, the institution so deeply embedded in the global financial system that its alumni occupy finance ministry positions around the world, and they were openly questioning the stability of the monetary system itself. Their research note detailed purchases that would have seemed impossible just 5 years earlier. The People's Bank of China, Goldman reported, had accelerated its gold acquisitions to levels not seen since the country began reporting such data. Official numbers showed China adding over 200 tons in 2025 alone, but Goldman's analysts suspected the real number was significantly higher, with purchases being made through intermediaries and sovereign wealth funds that didn't show up in traditional central bank reporting. India, despite its traditional role as the world's largest consumer of gold jewelry, was seeing something unprecedented. Premiums on gold in Indian markets had surged to their highest levels in a decade. Normally, gold in India trades at a small premium to international prices, reflecting import costs and local demand. But in January 2026, that premium had exploded to over $100 per ounce. Indian dealers were paying $4,600 for gold that was trading at $4,500 in London. Why? Because they couldn't get enough physical metal. Import quotas were being exhausted within days of each month opening. Jewelers were stockpiling. Wealthy families were converting rupees to gold at a pace that made government officials nervous about capital flight. The Indian government, sensing potential economic instability, was rumored to be considering emergency measures, possibly including increased import taxes on gold to slow the hemorrhaging of foreign exchange reserves. But perhaps the most telling indicator came from a market that most people had never heard of. The Shanghai Gold Exchange and the COMEX futures market in New York had traditionally traded at very similar prices, with only minor variations based on time zones and local supply-demand dynamics. But in January 2026, something broke. The spread between Shanghai physical gold and COMEX futures exploded to unprecedented levels. At one point, physical gold in Shanghai was trading at a premium of over $200 per ounce compared to New York paper gold. Think about what that means. In a properly functioning market with efficient arbitrage, such spreads should be impossible. If gold is trading for $200 more in Shanghai than New York, traders should simply buy in New York, ship it to Shanghai, and pocket the difference. That's arbitrage 101, the most basic mechanism that keeps global markets in sync. But the spread persisted, it widened, and that told sophisticated market observers something deeply troubling. Either the physical gold wasn't available to ship from west to east, or the paper gold being traded in New York, wasn't actually backed by physical metal in the quantities that the contracts implied. This was the nightmare scenario that gold bugs had been warning about for decades, the concern that central banks and bullion banks had dismissed as conspiracy theory nonsense. The idea that the gold market had become so financialized, so dependent on paper contracts and digital ledgers, that the actual physical metal couldn't be delivered in the quantities that the derivatives market suggested existed. Silver, meanwhile, was experiencing its own crisis of legitimacy. The white metal had always been gold's volatile younger sibling, prone to dramatic swings that made it beloved by speculators and dreaded by conservative investors. But the move from $70 in late 2025 to over $100 in January 2026 was something else entirely. This wasn't speculation. This was panic buying. Industrial users, companies that rely on silver for solar panels, electronics, medical equipment, were suddenly facing a shortage that threatened production lines. Silver miners, who should have been celebrating the price surge, were instead facing a different problem. Many of them had sold forward production at much lower prices, locking in revenues at $60 or $70 per ounce when the metal was now trading at $100. These hedging contracts, designed to provide stability and guarantee cash flow, had become millstones around their necks. Some smaller mining companies were facing potential bankruptcy, not because their mines were unprofitable, but because their hedging strategies had backfired spectacularly. The situation was even more acute in the silver market than in gold because of a fundamental difference between the two metals. While gold is primarily a monetary metal with some industrial uses, silver is the opposite. Roughly half of all silver demand comes from industrial applications. It's used in solar panels, batteries, electronics, medical equipment, water purification systems. This means that when the silver price spikes, it doesn't just affect investors and speculators, it threatens real-world production of critical technologies. Solar panel manufacturers in particular were facing an existential crisis. The green energy transition that governments worldwide had been promoting, subsidizing, mandating, was suddenly becoming economically questionable as one of its key input costs doubled. Manufacturing costs for solar panels were spiking, threatening to make many installations economically unviable without even larger government subsidies. Politicians who had staked their careers on renewable energy promises were discovering that commodity markets don't care about political commitments, and this wasn't even the most dramatic part of the silver story. In late January, reports began circulating about an absolutely massive disparity between silver prices in Asia and the West. The Shanghai Futures Exchange was showing silver trading at a premium of $13 per ounce compared to COMEX, $13. On a metal trading at $100, that's a 13% premium. In commodity markets, where arbitrage opportunities are usually measured in cents or fractions of cents, a $13 spread was essentially a 5-alarm fire. It was a flashing red warning light that the global silver market was fracturing along geographical lines. Asian buyers, particularly in China and India, were willing to pay massive premiums for physical silver, while Western markets were still trading paper contracts at significantly lower prices. The implications were profound. Either physical silver was not flowing from west to east despite the enormous profit opportunity, suggesting logistics breakdowns or export restrictions, or the paper silver being traded in New York and London simply didn't exist in physical form. The latter possibility, while seeming far-fetched, was gaining credence among market analysts. For years, researchers had pointed out that the daily trading volume in paper silver contracts on the COMEX exchange represented far more silver than actually existed in registered vaults. On some days, the equivalent of the entire annual global silver production would trade hands multiple times in digital contracts. This was dismissed as normal market functioning, with bulls pointing out that most futures contracts are closed before delivery, so the paper-to-physical ratio doesn't matter. But what happens when everyone suddenly wants delivery? What happens when the music stops and everyone rushes for the chairs, only to discover there aren't enough chairs for everyone? That scenario, theoretical for so long, seemed to be playing out in real time. Reports from sources inside the COMEX were carefully worded but deeply concerning. Delivery delays were being reported. Warehouse stocks were declining rapidly. Some major banks were reportedly asking clients to settle silver contracts in cash rather than taking physical delivery, offering premiums to do so. This was unprecedented. The entire purpose of a futures market is to allow for physical delivery. When the delivery mechanism breaks down, when cash settlement becomes the norm rather than the exception, the market has fundamentally failed its core function. Their new price target for gold by the end of 2026, $5,400 per ounce. But it was the reasoning behind the forecast that truly caught attention. Now, to understand why this matters, why any of this should concern someone who doesn't own gold or silver, who has never traded a futures contract, who just wants to live their life and pay their bills, we need to step back and understand what money actually is. Because at the heart of this crisis, beneath all the technical jargon about spreads and premiums and delivery failures, is a question that humanity has grappled with for thousands of years. What gives money its value? Why do we accept pieces of paper or digital entries in a computer as payment for our labor, our products, our time? The answer, ultimately, is trust. We accept dollars because we trust that others will accept them tomorrow. We hold savings in bank accounts because we trust the banks will be there next year. We plan for retirement in dollar-denominated assets because we trust that those dollars will maintain purchasing power decades into the future. But trust, once lost, is nearly impossible to rebuild. And in January 2026, trust in the dollar system was evaporating faster than morning dew under a desert sun. The signs were everywhere if you knew where to look. Saudi Arabia, the linchpin of the petrodollar system for half a century, was quietly negotiating oil sales in yuan, not as a replacement for dollars, not yet, but as an option, a backup plan. The Saudis, whose entire modern prosperity had been built on their special relationship with America, whose security depended on American military protection, were hedging their bets. If Saudi Arabia was preparing for a post-dollar world, everyone else needed to pay attention. The BRICS nations, that alphabet soup of emerging economies that cynics had long dismissed as too diverse and contradictory to ever amount to anything, were suddenly showing unprecedented coordination. Brazil, Russia, India, China, South Africa, and now a growing list of potential new members were actively discussing alternatives to dollar-based trade settlement. A BRICS development bank was being expanded. Bilateral currency swap agreements were proliferating. These weren't just discussion papers and academic conferences anymore. This was real infrastructure being built, real alternatives being created. Most ominously for dollar dominance, these countries represented the bulk of global commodity production: oil from Russia and the Middle East, rare earth minerals from China, agricultural products from Brazil. If these nations decided to conduct trade in currencies other than dollars, if they created their own clearing mechanisms and payment systems, the demand for dollars would plummet. And when demand for something falls while the supply keeps increasing, the outcome is as predictable as gravity. The value falls. But perhaps the most significant shift was happening not in government ministries or central bank boardrooms, but in the private sector. Corporate treasurers, the cautious professionals who manage company cash reserves, were beginning to diversify into gold. This was revolutionary. For decades, corporate treasury management had been simple. You held your cash in dollars, maybe a bit in euros or yen if you had international operations, and you invested in safe, liquid instruments like treasury bills or high-grade corporate bonds. Holding gold was considered eccentric at best, irresponsible at worst. Gold pays no interest. It generates no cash flow. It just sits there, inert, while inflation erodes its purchasing power. At least that was the conventional wisdom. But in 2025 and into 2026, that wisdom was being reconsidered. Companies were looking at their dollar holdings and doing uncomfortable math. Real interest rates, the interest you earn minus the inflation rate, were negative or barely positive. Meanwhile, gold was appreciating at double-digit annual rates. The opportunity cost of holding gold had flipped. You were losing money by not holding it. MKS PAMP, one of the world's largest precious metals refiners, announced plans for a major expansion of gold refining capacity in the United States. This wasn't a small boutique operation. This was industrial-scale infrastructure being built to handle the anticipated surge in gold demand. The company's executives, in carefully worded statements, talked about reshoring precious metals, refining capacity, and ensuring supply chain security. What they didn't say, but what everyone understood, was that they were preparing for a world where gold moved from east to west less freely, where geopolitical tensions might disrupt traditional refining routes through Switzerland and the United Arab Emirates. Even more telling, the U.S. Mint announced the appointment of a new director, Paul Hollis from Louisiana, at a time when demand for American Eagle gold and silver coins had reached levels not seen since the financial crisis of 2008. Premiums on physical coins over spot prices had exploded. Dealers were reporting wait times of weeks or months for delivery. Some were simply refusing new orders because they couldn't secure enough supply from the mint to fulfill existing commitments. This was the retail side of the gold market, the ordinary citizens and small investors who were voting with their wallets. And they were voting overwhelmingly for physical precious metals over paper assets. The dichotomy was striking. On one hand, you had paper gold and silver, the futures contracts and exchange-traded funds, which were experiencing some price appreciation but nothing like the physical market. On the other hand, you had actual metal, coins, and bars you could hold in your hand, which was trading at enormous premiums and was increasingly difficult to obtain at any price. This bifurcation suggested something profound. The market was beginning to distinguish between claims on gold and actual gold. between promises to deliver metal and metal in hand, between counterparty risk and no counterparty risk. This distinction, academic for so long, was suddenly very real and very expensive. Now let's talk about VanEck, an investment management firm with deep expertise in precious metals. In January 2026, their research team published analysis that sent shockwaves through the investment community. The title alone was enough to make people stop scrolling. If the dollar loses reserve status, could gold surpass $39,000? $39,000, not $4,000, not $5,000, $39,000 per ounce? The number seemed absurd, the kind of clickbait headline designed to generate social media engagement rather than serious analysis. But VanEck's methodology was sobering and difficult to dismiss. They started with a simple premise. The dollar's reserve status is not a law of nature. It's a historical contingency that emerged from specific circumstances, American economic dominance after World War II, the Bretton Woods Agreement, the petrodollar system. These circumstances can change. Indeed, they are changing. If the dollar were to lose its reserve status, not disappear entirely, but simply decline from representing 60% of global reserves to, say, 30%, the implications would be staggering. Countries holding dollars as reserves would need to diversify into something else. But into what? Euros? The European Union has its own problems, including demographic decline and structural economic weaknesses. Yuan? China's capital controls and authoritarian governance make it unattractive as a reserve currency. Yen? Japan's debt-to-GDP ratio is over 200%. No, VanEck argued, the only asset with sufficient history, liquidity, and neutrality to absorb a major shift away from dollar reserves would be gold. And if central banks needed to shift even a fraction of their current dollar holdings into gold, the demand would dwarf anything the market had ever seen. Here's where the math gets interesting. Global central bank reserves total roughly $12 trillion. If just 10% of that, $1.2 trillion, shifted into gold, and if the annual gold mining production remains around 3,000 tons, producing roughly $200 billion worth of new gold, each year at current prices, you'd need the gold price to rise dramatically to equilibrate supply and demand. VanEck's models, incorporating various assumptions about the speed of reserve diversification and the elasticity of gold supply, produced scenarios where gold could reach anywhere from $10,000 to nearly $40,000 per ounce. Were these predictions certain? Of course not. Economic modeling is as much art as science, particularly when dealing with unprecedented scenarios. But the analysis forced serious investors to consider possibilities they had previously dismissed as impossible. And once you admit that gold at $10,000 is possible, that gold at $20,000 is conceivable, your entire investment strategy changes. Suddenly, allocating 5 or 10% of your portfolio to gold doesn't seem like a fringe bet. It seems like prudent risk management. The institutional money was starting to move, slowly at first, then with increasing urgency as January 2026 progressed. When the delivery mechanism breaks down, when cash settlement becomes the norm rather than the exception, the market has fundamentally failed its core function. Their new price target for gold by the end of 2026, $5,400 per ounce. But it was the reasoning behind the forecast that truly caught attention. Italy and Germany, as part of a broader European initiative, announced they were seeking greater security in raw materials supplies, particularly in light of China's dominance in critical minerals. This wasn't directly about gold, but it represented the same mindset, the same concern about dependence on potentially unreliable suppliers, the same desire for strategic autonomy. The Europeans were learning painfully and belatedly that globalization had made them vulnerable. When you outsource critical production, when you depend on supply chains that cross multiple countries and jurisdictions, you introduce risks that can't be hedged with financial instruments. The only real security comes from domestic production or supplies from absolutely reliable allies. And in 2026, the list of absolutely reliable allies was getting shorter. This brings us to a question that many were asking, but few were willing to answer publicly. If gold was surging because of fear and uncertainty, if it was a bet against the dollar system, what happened if the dollar actually collapsed? What if the United States faced a currency crisis, a loss of reserve status, a Argentina-style hyperinflation? Would gold at $4,800 or $6,500 or even $39,000 be enough? Or would we be looking at a complete breakdown of the monetary system, where prices became meaningless because the measuring stick itself had failed? These were dark thoughts, the kind of scenarios that respectable economists dismissed as doomerism and fear-mongering. But they were being discussed in private conversations, in secure messaging apps, in off-the-record briefings. The people at the highest levels of finance and government were at least considering possibilities that would have been unthinkable before. And they were making preparations, buying farmland, stockpiling supplies, acquiring citizenship in multiple countries, yes, and buying gold, lots of gold. The wealth management industry was seeing unprecedented demand for what they called alternative assets. Not just gold and silver, but platinum, palladium, rare earth minerals, even gemstones and art. Anything that held value outside the traditional financial system was suddenly attractive. Family offices managing billions for ultra-high net worth individuals were dedicating entire teams to sourcing and securing these assets. It wasn't enough to own paper claims. Clients wanted physical possession or, at minimum, allocated storage in maximum security vaults in politically stable jurisdictions. Switzerland, with its long history of banking secrecy and political neutrality, was seeing a renaissance in gold storage demand. The Swiss had always been major players in the gold market, both through their banking system and through refineries that processed much of the world's gold. Now they were building additional vault capacity to meet surging demand. Singapore was experiencing similar growth. The city-state had positioned itself as Asia's premier financial center, and part of that positioning involved offering world-class precious metals storage. Ultra-secure vaults with biometric access, regular audits, full insurance, all located in a country with strong rule of law and minimal political risk. For Asian investors who didn't trust Chinese authorities and were increasingly skeptical of Western financial centers, Singapore offered an attractive middle path. Even the Cayman Islands, long known as a tax haven for financial assets, was building infrastructure for physical precious metals storage. The demand was global, spanning every continent, every wealth level, from small retail investors to sovereign wealth funds. Frank Holmes, a veteran precious metals investor and CEO of U.S. Global Investors, published commentary in late January that captured the moment perfectly. Gold, he noted, was advancing to new record highs on questions over Federal Reserve independence. This was a polite way of saying what many were thinking. The Fed's credibility was shot. Years of promising that inflation was transitory, then being proven wrong. Years of forward guidance that changed with each new data release. Years of political pressure from administrations of both parties to keep monetary policy loose. The institution that was supposed to be the lender of last resort, the guarantor of financial stability, the steady hand on the monetary tiller, was increasingly seen as just another political actor responding to short-term pressures. If you couldn't trust the Fed to maintain price stability, if you couldn't trust the Fed to preserve the dollar's purchasing power, then you needed alternatives. Gold was that alternative. It had been that alternative for 5,000 years of human civilization. Every empire that had debased its currency, from Rome to Weimar Germany to modern Zimbabwe, had seen citizens flee to gold when the official money became unreliable. America in 2026 was facing the same dynamic. Quantum Strategy, another investment research firm, went even further. Their analysts were predicting gold at $6,000, not as a long-term target, but as a near-term possibility. Their reasoning focused on technical factors, the momentum in the market, the buying pressure that seemed insatiable, the lack of sellers willing to part with physical metal at any price. When markets become one way, when everyone wants to buy and nobody wants to sell, prices can spike to levels that seem irrational in retrospect, but are simply the market clearing price in the moment. The firm's veteran investors were telling clients to accumulate on any weakness, to use price dips as buying opportunities, to maintain or increase precious metals exposure regardless of how high prices went. This advice, coming from professionals who managed real money for real clients, represented a dramatic shift from the traditional financial planning orthodoxy. For decades, the conventional wisdom had been to hold perhaps 5 to 10% of a portfolio in precious metals as a hedge. Now serious investors were suggesting much higher allocations. Some were even suggesting that in the current environment, precious metals should be the core holding, with everything else as the hedge. The world was being turned upside down. CPM Group, one of the most respected precious metals research firms in the industry, weighed in with detailed analysis of the J.P. Morgan silver case. This was a legal proceeding that had been winding through courts for years, involving accusations that J.P. Morgan had manipulated silver prices through spoofing and other illegal trading practices. The bank had eventually paid substantial fines and admitted wrongdoing, but the case raised deeper questions about the integrity of the silver market. If a bank as large and sophisticated as J.P. Morgan was engaging in manipulation, if the patterns were so blatant that even the notoriously bank-friendly regulators had to act, what did that say about the market as a whole? How much of the silver price over the previous decade had been artificial, suppressed below where supply and demand fundamentals would have placed it? And now that the manipulation had been exposed, now that banks were presumably being more careful, was the market finally discovering the true price of silver? These questions had no definitive answers, but they added to the sense that something fundamental had changed, that the old rules no longer applied, that price discovery was happening in real time in ways that surprised even seasoned market participants. ING, the Dutch banking giant, published a brief note when silver crossed $100 per ounce for the first time. The note was remarkable for what it didn't say. There was no attempt to explain the move with traditional fundamental analysis, no discussion of supply deficits or industrial demand growth, just a simple acknowledgement that silver had hit $100, a milestone that few had expected to see. The subtext was clear. Even sophisticated bank analysts had no coherent framework for understanding what was happening. The markets had moved beyond their models, beyond their forecasting abilities. All they could do was observe and report, trying to help clients navigate uncharted waters. And uncharted was the right word. We were in territory that had no historical parallels. Yes, gold had been higher in inflation-adjusted terms during the 1980 peak. Yes, silver had briefly touched $50 in 1980 and again in 2011. But the broader context was unprecedented. The combination of geopolitical tension, monetary policy uncertainty, supply chain fragility, reserve currency doubts, all of it coming together in a perfect storm that was reshaping the global financial landscape. Some analysts were drawing comparisons to the 1970s, the last time gold had experienced a major bull market. There were certainly similarities: the inflation, the geopolitical tensions, the loss of confidence in government institutions. But there were also crucial differences. The 1970s gold bull market occurred in a world where America was still the undisputed hegemon, where the Soviet Union was a declining power, where China was an impoverished agricultural society. Today, America faced real peer competitors. China's economy was in some measures as large as America's. The BRICS nations collectively represented a larger share of global GDP than the G7. The unipolar moment of American dominance after the Cold War had ended. We were entering a multipolar world, and such transitions are historically turbulent. Another key difference was the level of debt in the global system. In 1980, U.S. federal debt was roughly 30% of GDP. In 2026, it exceeded 120%. Corporate debt, household debt, state and local government debt, all were at or near record levels. The entire global economy was leveraged to a degree that would have seemed insane to previous generations. This debt overhang created a massive incentive for inflation. Debt becomes easier to service when the currency depreciates. A debtor nation benefits from inflation, and America was now the world's largest debtor. The temptation to inflate away the debt, to let the dollar depreciate while maintaining nominal economic activity, would be overwhelming for any administration. The Fed could talk about maintaining price stability, about its 2% inflation target, but when push came to shove, when the choice was between allowing deflation that would make debts crushing or permitting inflation that would erode their real value, which would they choose? Gold investors were betting they knew the answer, and they were positioning accordingly. By late January, the precious metals market had taken on a life of its own, a momentum that seemed unstoppable. Trading volumes on major exchanges were hitting records. Retail investor interest, measured by online searches and account openings at precious metals dealers, was at levels not seen since the financial crisis. Social media was flooded with gold and silver content, from serious analysis to wild speculation to outright hype. The fear of missing out, that powerful psychological force that drives bubbles, was clearly at work. People who had ignored precious metals for years were suddenly desperate to get exposure. People who had small positions were trying to increase them. People who had been skeptical were reconsidering. The narrative had shifted from whether to own gold to how much gold to own. And narratives, once they shift, can be powerful forces. They can become self-fulfilling prophecies, driving prices higher, which validates the narrative, which brings in more buyers, which drives prices higher still, until something breaks, until the narrative shifts again, until the music stops. But when would that be? What would cause it? These were the questions that kept precious metals investors awake at night, checking prices at 3 a.m, reading every news headline for signs of what might come next. The tension was exhausting, exhilarating, terrifying all at once, because underneath all the market dynamics, all the technical analysis, all the geopolitical speculation, was a deeper fear. The fear that we were living through a historical turning point, a moment when the monetary system that had governed global commerce for 3/4 of a century was breaking down. The fear that our children would look back at this time and mark it as when everything changed. The fear that the relative peace and prosperity of the post-war era was ending, to be replaced by something more chaotic, more dangerous, more uncertain. Gold and silver in this context were more than investments. They were insurance policies against catastrophe. They were wealth preservation in its most fundamental form. They were a bet that no matter what happened to governments, currencies, or financial markets, these metals would retain value because they always had. For 5,000 years, through the rise and fall of countless empires, gold had been money. For thousands of years, silver had served the same purpose. Paper currencies came and went. The Roman denarius, the Byzantine solidus, the Spanish pieces of 8, the British pound sterling in its gold-backed form, the Bretton Woods dollar, all had their moments of dominance and all had eventually been debased, devalued, or destroyed. But gold remained. Silver remained. They were the constants in a world of variables, the anchors in a sea of monetary chaos. This historical perspective provided comfort to precious metals investors even as prices reached levels that would have seemed absurd years earlier. They weren't buying gold at $4,500 because they thought it was cheap. They were buying it because they believed the alternative, holding wealth in depreciating paper currencies, was even worse. So where do we go from here? As January 2026 drew to a close, as traders and investors prepared for what February might bring, the questions multiplied faster than answers. Would Germany get its gold back? Would the Federal Reserve cave to political pressure and ease monetary policy despite elevated inflation? Would the China-Taiwan situation spiral into actual conflict? Would another country's reserves be frozen, confirming the worst fears about asset security? Would the COMEX default on silver deliveries, breaking the futures market? Would gold reach $5,000, $6,000, $10,000? Would silver double again, reaching $200? Or would some unexpected development, some black swan event that nobody was anticipating, change everything overnight? The only certainty was uncertainty. The only safe prediction was that predictions would prove wrong, but through it all, the gold market would remain a barometer of trust. When gold prices rise, it signals declining confidence in the existing system. When gold prices fall, it signals returning confidence. And in late January 2026, gold prices were screaming a message that was impossible to ignore. The world had lost faith in the dollar system. Whether that faith could be restored, whether some combination of policy changes and diplomatic reassurances could reverse the trend, remained to be seen. But the burden of proof had shifted. It was no longer on gold bugs to explain why anyone should own precious metals. It was on defenders of the status quo to explain why anyone shouldn't. For individual investors, the decisions were deeply personal and consequential. How much of your wealth should be in precious metals? Should you buy physical coins and bars, or are ETFs and mining stocks sufficient? Do you store metal at home, risking theft, or in a bank vault, risking confiscation or bank failure? Do you buy now at record prices, or wait for a pullback that might never come? These weren't abstract questions. They were decisions that could determine whether you preserved your wealth through the coming turbulence or watched it evaporate in a currency crisis. And nobody, no matter how confident they seemed, really knew the right answers. The experts were guessing, the analysts were speculating, the professionals were hedging their language with caveats and disclaimers. Because honest people recognized that we were in uncharted territory, navigating by dead reckoning through a storm that showed no signs of abating. Some found this uncertainty paralyzing, unable to act because every option carried risks. Others found it liberating, freed from the tyranny of conventional wisdom to make their own assessments and place their own bets. But nobody could afford to ignore it. The precious metals surge of 2026 wasn't some niche market phenomenon affecting only a few gold bugs and conspiracy theorists. It was a fundamental repricing of risk, a redistribution of global wealth, a challenge to the monetary order that governed the world economy. You didn't need to own gold to be affected by it. If you held dollars, if you earned a salary, if you had savings in a bank, if you owned stocks or bonds or real estate, the gold price rise was telling you something important about the value and stability of all those other assets. It was a warning light flashing on the dashboard of the global economy, and whether you heeded that warning or dismissed it as a false alarm was perhaps the most important financial decision you would make. As we close this story, or rather as we pause it, because the story is far from over, consider where you stand. Are you prepared for a world where gold trades at $6,000, $10,000, even VanEck suggested $39,000? Are you prepared for a world where the dollar loses its reserve status and Americans suddenly discover what citizens of lesser countries have always known? That your currency's value is not guaranteed, that savings can be eroded, that what seems permanent can prove ephemeral? Are you prepared for a world where the financial system that has existed for your entire life, that seems as solid and unchanging as the ground beneath your feet, turns out to be as fragile as every monetary system before it? Or perhaps the bulls are wrong. Perhaps this is all hysteria and speculation, a bubble that will pop spectacularly, leaving late buyers holding worthless metal that will spend the next decade depreciating back to more reasonable levels. Perhaps central banks will intervene successfully. Perhaps geopolitical tensions will ease. Perhaps the dollar will reassert its dominance and gold will return to being a barbarous relic held only by those who failed to understand modern finance. Both scenarios are possible. Both have historical precedent. The truth most likely lies somewhere in between, messier and more complicated than either the bulls or bears imagine. But that truth will only be known in retrospect, years from now, when we can look back at January 2026 and understand what it really meant. For now, all we can do is watch the prices tick higher, read the headlines, make our decisions, and hope we're positioned correctly for whatever comes next. The gold market has spoken. It has delivered its verdict on the current monetary system. Whether that verdict is just, whether it will stand, whether it represents wisdom or madness, time will tell. Until then, we watch, we wait, we prepare. And we remember that in the entire history of human civilization, no fiat currency has survived indefinitely. All have eventually failed, some through hyperinflation, some through war, some through simple neglect and mismanagement. The dollar has lasted longer than most. It has seemed more stable, more permanent, more trustworthy, but it too is just paper, just electrons in a computer, just a collective agreement that these symbols represent value. And when collective agreements break down, when trust evaporates, when confidence turns to fear, paper returns to its intrinsic value, which is approximately nothing. Gold, on the other hand, remains gold, indestructible, unchanging, valuable, as it has been for 5,000 years. As it will be for 5,000 more. That's the bet precious metals investors are making. That's the message the market is sending. Whether you listen to that message or ignore it is up to you, but you can't say you weren't warned. What would cause it? These were the questions that kept precious metals investors awake at night, checking prices at 3 a.m, reading every news headline for signs of what might come next. The tension was exhausting, exhilarating, terrifying, all at once. Because underneath all the market dynamics, all the technical analysis, all the geopolitical speculation, was a deeper fear. The fear that we were living through a historical turning point, a moment when the monetary system that had governed global commerce for 3/4 of a century was breaking down. The fear that our children would look back at this time and mark it as when everything changed. The fear that the relative peace and prosperity of the post-war era was ending, to be replaced by something more chaotic, more dangerous, more uncertain. Pension funds, sovereign wealth funds, family offices managing billions for the ultra-wealthy, all were increasing their precious metals allocations. Some were buying physical gold and storing it in private vaults in Switzerland, Singapore, and increasingly in secure facilities within their own countries. Others were purchasing shares in gold mining companies, betting that the companies extracting gold from the earth would benefit enormously from higher prices. Still others were buying allocated gold through specialized dealers, insisting on specific bars with serial numbers, stored in segregated vaults where their metal couldn't be commingled with others or used for lending. This insistence on allocated segregated storage was itself a telling indicator. It suggested deep skepticism about the traditional banking system's gold storage practices. For decades, most institutional gold storage had been unallocated, meaning you owned a claim on a certain quantity of gold but not specific bars. The gold was pooled, and the bank could use it for various purposes, including lending to other parties. This system worked fine as long as everyone didn't demand their gold at once, but it was precisely this assumption that was now being questioned. What if everyone did demand their gold simultaneously? What if the unallocated gold had been lent out multiple times, creating claims that exceeded the physical metal available? These weren't idle concerns. They were based on decades of analysis by researchers who had painstakingly documented the gold leasing practices of central banks and bullion banks. The London Bullion Market Association, the organization that oversees the largest physical gold market in the world, had always been somewhat opaque about the exact quantities of gold in London vaults and the extent to which that gold was encumbered by multiple claims. Transparency was not the market's strong suit. But in January 2026, that opacity was becoming a liability. Investors wanted proof. They wanted assurance. They wanted to know that the gold they owned actually existed in physical form sitting in a vault somewhere with their name on it. This flight to allocated, segregated storage was creating bottlenecks. Vault space in politically stable jurisdictions was becoming scarce. Premium vaulting services that offered highest level security and regular audits were quoting wait times of months for new clients. The infrastructure simply hadn't been built to handle this level of demand for physical metal storage. And this brings us to one of the most fascinating aspects of the current precious metals surge. The role of technology, or more specifically, the failure of technology to solve what many had assumed would be a technological problem. For years, financial innovators had promoted digital solutions to gold ownership, blockchain-based gold tokens, digital certificates backed by physical gold, apps that let you buy fractional ounces of gold stored in vaults. These innovations were supposed to democratize gold ownership, making it accessible to everyone with a smartphone. And to some extent, they succeeded. Millions of people who would never have gone to a coin dealer or opened a precious metals brokerage account were able to buy small amounts of gold through user-friendly apps. But in the crisis of 2026, these digital solutions were revealing their limitations. When push came to shove, people didn't want digital claims on gold. They wanted gold. They wanted to feel the weight of a coin in their hand. They wanted the reassurance that comes from physical possession. No app, no matter how well designed, could provide that visceral certainty. The surge in demand for physical coins and small bars was overwhelming dealers worldwide. In the United States, premiums on American Eagle coins reached 15 to 20% over spot price. In some cases, dealers were paying more than spot price just to acquire inventory, then marking it up further for retail customers. The U.S. Mint, operating at maximum capacity, simply couldn't produce enough coins to meet demand. Similar situations were playing out globally. Canadian Maple Leafs, South African Krugerrands, Austrian Philharmonics all were trading at substantial premiums and were difficult to obtain. This created a bizarre situation where sophisticated investors with millions of dollars were struggling to convert their wealth into physical precious metals, not because they couldn't afford it, but because the metal simply wasn't available in the quantities they wanted. Some were chartering private jets to personally collect gold purchases from dealers in different cities. Others were offering substantial premiums to jump waiting lists. The desperation was palpable and growing. Meanwhile, the geopolitical situation continued to deteriorate in ways that fed directly into precious metals demand. The situation between the United States and China over Taiwan was reaching dangerous levels of tension. American naval forces were conducting freedom of navigation exercises in the Taiwan Strait with increasing frequency. China was responding with military exercises that looked increasingly like invasion rehearsals. Both sides were locked in a game of chicken, each convinced the other would blink first, neither willing to back down. The economic implications were staggering. If conflict erupted, if China invaded Taiwan, or if the United States intervened militarily, the global economy would face disruption that would make the COVID pandemic look like a minor inconvenience. Taiwan produces the majority of the world's advanced semiconductors. These chips are in everything from smartphones to cars to military weapon systems. A disruption to Taiwanese production would cascade through every major industry. But beyond the immediate economic impacts, a US-China conflict would shatter whatever remained of the dollar-based global order. China holds over $1 trillion in US Treasury securities. In a conflict scenario, these holdings could be weaponized, either through mass selling that would spike interest rates or through outright repudiation. The United States, in turn, could freeze Chinese assets held in American institutions, just as it had done with Russia. The financial warfare would be as significant as any military engagement. Investors watching these developments were making rational calculations. In a world of escalating great power conflict, in a world where reserve assets can be frozen or seized for political reasons, gold's ancient appeal reasserted itself. Gold has no counterparty risk. It can't be printed into existence by a central bank. It can't be frozen by a government. It exists outside the financial system, a form of wealth that has survived every empire, every currency collapse, every financial crisis in human history. This wasn't barbarous relic thinking. This was cold-eyed risk assessment by some of the smartest investors in the world. They were looking at the game board, seeing the pieces in motion, and making preparations for scenarios that would have seemed unthinkable just a few years earlier. But let's bring this back to Germany and the question we started with, because in many ways, Germany's dilemma encapsulated the entire crisis. Germany found itself caught between its Atlantic alliance with the United States and its economic pragmatism. Decades of industrial policy had made Germany dependent on cheap Russian energy and Chinese markets. The country's vaunted manufacturing sector, the Mittelstand companies that produced everything from machine tools to luxury cars, needed both. But the United States was demanding that Germany choose. Cut ties with Russia completely, reduce economic dependence on China, increase military spending to NATO targets, accept American liquefied natural gas at prices far higher than Russian pipeline gas had cost. The demands were existential for the German economic model, and now, hanging over all of it, was the question of Germany's gold. Those 1,236 tons sitting in New York vaults were worth approximately $80 billion at current prices. That represented a substantial portion of Germany's national wealth. More importantly, it represented a tangible asset that couldn't be inflated away, that couldn't be devalued by monetary policy decisions in Washington or Frankfurt. It was real wealth, the kind of wealth that provided options in a crisis. The German public, increasingly aware of these dynamics through media coverage and social media discussion, was demanding answers. Why was their gold still in New York? Why couldn't it be repatriated immediately? What were the American authorities saying when German officials made inquiries? The Bundesbank's carefully worded public statements did little to reassure an increasingly skeptical population. They spoke of ongoing discussions, of logistical considerations, of the need to maintain good relations with international partners. But the German people were reading between the lines, and they didn't like what they saw. Their gold was being held hostage, whether officially acknowledged or not. The political pressure was becoming unbearable for the coalition government. Opposition parties were demanding emergency parliamentary sessions. The far-right AfD party, always eager to exploit nationalist sentiment, was calling for immediate repatriation and threatening to make it a central campaign issue in upcoming elections. Even mainstream parties that traditionally supported the transatlantic alliance were feeling pressure from their constituents. Nobody wanted to be the politician who let Germany's gold remain vulnerable to American political whims. In late January, leaked reports suggested that Germany was preparing to send a high-level delegation to Washington for urgent discussions. The ostensible purpose would be broad strategic dialogue, but insiders knew the real agenda. Germany wanted its gold back, and it wanted assurances that the transfer would begin immediately. The Americans, for their part, were in a difficult position. Returning Germany's gold would be seen as capitulation to political pressure, a sign of weakness that might encourage other countries to make similar demands. But refusing or stalling too obviously would confirm the worst suspicions, that the gold wasn't readily available, that something was wrong with the storage arrangements. It was a lose-lose scenario, the kind of diplomatic crisis that emerges when trust has eroded beyond repair. And trust, let's be clear, had eroded catastrophically. The sanctions on Russia, however justified they might have been on moral or strategic grounds, had demonstrated that the United States was willing to weaponize the financial system in ways that made other countries deeply uncomfortable. Cumulative word count, 6,533 words. The message was clear: hold your reserves in dollars, store your gold in New York, and you're subject to American foreign policy decisions. Step out of line, and those assets could be frozen, seized, or otherwise weaponized against you. This realization was driving the gold surge as much as any technical market factor. It was a vote of no confidence in the dollar system, expressed not through words, but through market action. Central banks were buying gold at record levels because they were terrified of being the next Russia, the next country that wakes up to find its foreign reserves inaccessible. Now, some observers argued that this fear was overblown, that the Russia situation was unique, that democratic countries with strong rule of law had nothing to worry about. But this argument missed the point entirely. The issue wasn't whether freezing was likely for any particular country. The issue was that it was possible at all. Once you know your reserves can be frozen, once you've seen it happen to another country, the risk calculus changes completely. It's like learning that your bank could close your account for political reasons. Even if you think you'll never be targeted, even if you consider yourself completely safe, the knowledge that it's possible changes your relationship with that bank. You start looking for alternatives, you diversify, you reduce your exposure, and that's exactly what was happening in January 2026 on a global scale. Countries were diversifying away from dollar dependence, and the primary beneficiary was gold. But gold wasn't the only story. Silver's surge past $100 per ounce was creating its own set of dynamics. Unlike gold, which is primarily a monetary metal, silver has massive industrial demand. This meant that the silver price spike was having immediate real-world consequences beyond the financial markets. The solar panel industry, as mentioned earlier, was in crisis. Manufacturing costs had exploded. Projects that had been planned and permitted based on certain cost assumptions were suddenly uneconomical. Government subsidies that had seemed generous were now inadequate. Some solar installation companies were going bankrupt, unable to fulfill contracts signed at lower silver prices. The electric vehicle industry was facing similar pressures. Modern EVs use substantial amounts of silver in their electrical systems. Some models use over 1 kilogram of silver per vehicle. At $30 per ounce, that represented a manageable cost. At $100 per ounce, it was eating significantly into profit margins on vehicles that were already struggling to compete with traditional internal combustion engines on price. The medical industry was another major silver consumer. Silver's antimicrobial properties make it essential in medical devices, wound dressings, and various healthcare applications. Hospitals and medical device manufacturers were facing supply chain disruptions and cost increases that were forcing difficult decisions about which silver-containing products were truly essential. But perhaps the most significant impact was in the photography and electronics industries. While digital photography has largely replaced film, there are still specialty applications where traditional silver-based film is used. More importantly, silver is a critical component in electronics manufacturing, used in everything from circuit boards to solar cells to batteries. The electronics giants, companies like Samsung, Apple, and others, were facing a dilemma. They could absorb the higher silver costs, eating into profit margins, or they could pass the costs on to consumers, risking market share. Either way, the era of ever cheaper electronics was facing a potential reversal. And this raises a fascinating paradox. The green energy transition, the shift to renewable energy and electric vehicles that governments worldwide had been promoting as essential to combat climate change, was being undermined by the very market forces that the transition was helping to create. Solar panels require silver. Demand for solar panels had been surging. This increased demand for silver. The silver price rose. Higher silver prices made solar panels more expensive. More expensive solar panels slowed the green transition. It was a feedback loop that nobody had really anticipated, or at least nobody in positions of power had taken seriously. The assumption had always been that mining production would increase to meet demand, that higher prices would incentivize new mines, and that any supply constraints would be temporary. But silver mining doesn't work like turning on a tap. Discovering a new silver deposit takes years. Permitting and building a mine takes more years. Even existing mines can't simply double production overnight. There are geological constraints, equipment limitations, labor availability issues. The silver market was discovering that supply is far more inelastic than anyone had assumed, and the price was reflecting that reality. The CFTC, the Commodity Futures Trading Commission that oversees American commodity markets, released its weekly Commitments of Traders report in late January. The data showed something remarkable. Speculative net long positions in gold futures had surged to 251,000 contracts, up from 228,000 the previous week. Each contract represents 100 troy ounces of gold. So this represented an increase in speculative positioning of over 2 million ounces, roughly 70 tons of gold. But here's what was interesting. The report showed that much of this positioning was coming not from the usual hedge funds and managed money accounts, but from entities classified as commercial traders. These are typically industry participants like miners, jewelers, and bullion banks who use futures markets for hedging rather than speculation. When commercial traders are going long, buying gold futures rather than selling them, it suggests something profound. It suggests that even the industry insiders believe prices are going higher. It suggests that the normal hedging patterns, where miners sell forward production and jewelers hedge inventory, are breaking down. It suggests that everyone, even those with deep industry expertise and insider knowledge, is positioning for a massive move higher. The London Bullion Market Association, trying to bring some analytical rigor to the chaos, published their annual Precious Metals Forecast Survey in January 2026. This survey polls dozens of analysts, traders, and industry experts for their price predictions. The results were stunning. The average forecast for gold by the end of 2026 was $4,800 per ounce. The high forecast was $6,500. The low forecast was $4,200. Think about what this means. Even the most bearish experts surveyed believed gold would trade above $4,000 by year end. The most bullish saw it pushing toward levels that would have been considered lunatic fringe predictions just months earlier. And these weren't random people on the internet. These were professionals, people whose careers depended on making accurate market calls, who had reputations to protect. For them to go on record with such bullish forecasts indicated a consensus that the precious metals bull market was real, substantial, and likely to continue. Silver forecasts were similarly extraordinary. The survey average put silver at $120 by year end, with high forecasts approaching $150. Again, even the bears expected triple-digit silver to persist throughout the year. The implications were staggering. If these forecasts proved accurate, and that remained a big if, the total value of gold held by central banks worldwide would increase by trillions of dollars. Countries like China, that had been accumulating gold, would see massive gains on their reserves. Countries that had sold gold in previous decades, like the United Kingdom, which famously sold over 400 tons at prices around $250 per ounce in the early 2000s, would be regretting those decisions with increasing bitterness. The geopolitical ramifications would reshape global power structures. But forecasts are just forecasts, educated guesses based on current trends and assumptions about the future. Markets have a way of confounding even the most confident predictions. So what could derail the gold and silver bull markets? What could cause prices to collapse back to more normal levels? The bears, those brave souls willing to stand against the bullish tide, had several arguments. First, they pointed to the possibility of central bank intervention. If gold prices became destabilizing to the financial system, if they started triggering bank failures or currency crises, central banks might coordinate to suppress prices. This could take various forms, from massive gold sales to margin requirement changes on futures exchanges to outright market manipulation. Conspiracy theorists had long claimed that central banks were actively suppressing gold prices to protect the dollar. While evidence for such claims was always murky, it was undeniable that central banks had the tools and potentially the motive to intervene if they deemed it necessary. A coordinated sale of even a few thousand tons of gold could flood the market and drive prices lower, at least temporarily. Second, the bears argued that the current price surge was driven by fear and speculation rather than fundamentals. Once the geopolitical tensions eased, once some of the uncertainty resolved, once the fear trade unwound, prices could collapse rapidly. This had happened before. Gold hit $850 in 1980 during the last major precious metals bull market, then spent the next 2 decades in a grinding bear market that eventually saw prices below $300. Investors who bought at the top in 1980 and held on were underwater for decades. The bulls, in response, argued that this time was different. The geopolitical situation wasn't a temporary scare, it represented a fundamental realignment of global power structures. The dollar's reserve status wasn't going to be shored up by a few reassuring statements from the Federal Reserve. The trust that had eroded wasn't coming back. And the central bank buying, the industrial demand, the investment demand, all of these represented structural changes to the gold market that couldn't be easily reversed. Who was right? In late January 2026, nobody knew for certain. Markets were moving so fast, developments were coming so rapidly, that even experienced traders were struggling to keep up. What seemed certain on Monday would be overturned by Friday. Predictions made with confidence in the morning would be revised by afternoon. It was chaos, exhilarating for some, terrifying for others, but impossible to ignore. One development that caught many observers by surprise was Thailand's sudden announcement of measures to curb gold's impact on the Thai baht. The Bank of Thailand, concerned about what officials called gray money flows, was implementing restrictions on gold trading that would limit the metal's use as a currency alternative. This was significant because it represented a government acknowledging that gold was becoming a competitive threat to the national currency. In a functioning fiat money system, citizens should prefer the national currency for transactions. It's more convenient, more widely accepted, backed by legal tender laws. But when citizens start preferring gold, when they start using it as money despite its obvious inconveniences, it's a signal that they've lost faith in the currency. Thailand wasn't alone. Various countries were considering or implementing similar measures. India had long imposed import restrictions on gold to manage current account deficits. China maintained strict controls on gold imports and exports. Now other countries were joining them, each trying to manage the destabilizing effects of a gold market that was increasingly moving beyond government control.